What is a stock? What is an exchange traded fund? How do you make money in the stock market? Well, if you're new to investing or trading, these are important questions that you have. And in this video, Stock Trading for Beginners Episode 1, I'm going to walk you through those important concepts. And at the end of the video, I will show you a very simple but important technique that will help you do well in the market. So let's begin with what a stock is. Companies raise money by selling shares in their business to investors. These investors become shareholders. They own a small piece of the company. Now imagine you're a small business owner. You've got a great little business. You want to expand. You want to add more stores. Maybe you want to make new products. But you don't have the money to help with that growth. So you can issue shares in your company, sell those shares to investors, and those investors have given you capital in exchange for a little piece of your company. Well, public companies do the exact same thing. They issue shares to the general public, they get capital into the business to help grow the business, but in exchange, they've given up some ownership slice of the company. Essentially, these small companies become big companies by issuing a little slice of the pie to other investors in exchange for ownership. Now, if you want to know how many shares a company has outstanding, how many they've issued to shareholders, there's lots of free websites that will show you that. A good one is Yahoo Finance. You just go to finance.yahoo.com, and in the upper left here, you can type in a symbol. So I'll punch in the symbol for Apple, AAPL, click on Enter, and it brings up a lot of statistics on the company. If I go to the Statistics tab and scroll down the screen a little bit, there I can see share statistics, and I can see that the shares outstanding for this company is 15.2 billion. That means the company has issued 15.2 billion shares to investors who each own a very, very, very tiny slice of the pie. Now, another important number on this screen, and not so important with a stock like Apple, but it's the float number. You'll see here float, and you'll see that it says 15.818 billion. That's how many shares are in the public's hands to trade. Now, as I said, it's not really important for Apple, but there's a lot of people who have strategies where they focus on trading stocks that are actively traded but have a low float. So let me show you what that looks like. If I punch in the symbol of TNON, and I'll go down to the statistics again, and we'll scroll down to where it says share statistics. Here you can see that this company only has 493,000 shares outstanding, and there's only a float of 442,000 shares. What that means is that the public only has 442,000 shares to trade. Well, imagine if the company issued some news that had big implications for the company and there was then a strong demand for the stock. Well, what happens if there's a little bit of supply, in other words, not very many shares available to buy, but a strong demand for the stock because of some news that makes the company seemingly worth more? These stocks can make big jumps, and this is a great example of that. This TNON on the day that I am doing this video moved up 71% because it had a low float but a very strong demand to buy those shares, and that allowed that stock to make a big move. And that's something that there's trading strategies around that. I'll touch on that in a future episode of Trading for Beginners. Now, this stock really emphasizes why we even want to own stocks to begin with. If you own a stock and it goes up, that's how you can create wealth. That's how you can save for retirement. You can generate income for yourself from the stock market. So simply put, we want to own stocks because as a shareholder in the company, you can enjoy profits if the price of the stock goes up. Here's an example of what I mean. This is the shares of NVIDIA, and you can see that back here, the stock was in the $20 range, and over the course of, well, a couple of years, not even, the stock made these big rallies all the way up to $130 a share. If you're a shareholder and you bought the shares at $20 and then a year later you can sell the shares for $60, you've made 300%. Now the beautiful thing about the stock market is it really gives you the best long-term returns for any asset class. If you look at all of the investments out there in the world, nothing has outperformed the stock market over the long term. Now, in the short term, you'd get big crazes and things like crypto coins or real estate. But over the long term, the stock market really delivers the very best returns. Now, of course, with the stock market, there's also volatility. So even though you could earn 50% on an individual stock, you might also see other stocks that lose money, and your portfolio can have rises and falls. And so it's really important to make sure you learn how to pick the right stock and how to stay away from stock market crashes. And I'll show you a little trick that I've been using for many years to help you do that later in this video. All right, so the next thing, why do we want to own stock? Well, the other benefit is that when you own shares in a public company, those shares can be easily bought and sold through a broker on the stock market. It doesn't have the long wait times that you might have with some other assets, like if you own real estate, you want to sell a house, you don't just do it in 10 seconds. You have to put the house on the market and sometimes wait many months to get your money out of it. Well, in the stock market, it's not like that. If I want to sell $1 million worth of Apple, I click on a button on my phone or on a computer, and I'm out of that stock in less than a second, or if it's a large position, a few seconds anyway. But it doesn't take that long to move in and out of stocks. And that liquidity is one of the things that gives stocks value. All right, well, now let's get into the important stuff, and that is, why do stock prices change? Well, price of a stock is based on the market's perception of value. It's based on the future earnings potential of the company. So if we think back to our example of a small business, let's say you had a small business that made you $100,000 per year. What would you sell it for? Probably wouldn't sell it for $50,000, half of its earnings potential in just 1 year. Even $100,000 doesn't seem like a lot, because if you just keep the business for one more year, you are going to make the same amount. And so businesses will tend to sell for a multiple of their earnings. For a very conservative business site, that might be 7 or 8 times earnings. For a company that is growing rapidly, that might be 50 times earnings. So there's different multiples of earnings that people pay for different types of businesses. Now the next thing is, how does this all get priced in? Well, as investors get new information about a company's prospects, about its ability to make money in the future, price gets adjusted up or down. So if you think again about the company that you own, let's say you sign a new contract or you grow your product line, that sort of thing, you've just improved your company's ability to make money in the future, and that now makes your business worth more. Well, the same thing's happening in the stock market. When the market of investors, all those people that follow the company, when they learn about things that make the ability of the company to make more money in the future improve, then they are willing to pay more. So you can imagine, let's say you have a company that's trying to develop a cure for cancer. And they've got some other drugs that generate a certain amount of revenue every year, but they have this new drug that's coming on that's going to be a great treatment for colon cancer. Well, when the market learns about that, it's going to adjust the price it's willing to pay for that stock upward, because the company now has a greater ability to make money in the future. Now I want to emphasize one thing. What a company has done in the past, its past earnings, is not really important, because that's already priced into the stock. When you look at a stock that's trading at $20 a share, that's based on all of the things that the market already knows. The market moves on what will happen in the future. It's moving on what the future earnings will be. Now, of course, some companies make no money today, but the expectation is that eventually they're going to make money, and that's what investors are willing to pay for. All right, the third thing is realize that there's a lot of uncertainty in what stocks are worth. We don't know necessarily what a company is going to make in the future, and this is where that uncertainty comes in. So if you think about, the future earnings potential of an oil company, well, that company probably generates a certain amount of oil production, and it's a lot easier to predict what the future earnings will be based on the price of oil. Now, if the price of oil rises or falls, then that's going to change the company's ability to make money in the future. On the other hand, there's companies with a lot more uncertainty. Let's return to that example of a pharmaceutical company, a drug company. They may have a few drugs already in the market, but the uncertainty is whether their next drugs that are being developed are actually going to be effective. And so these stocks will tend to have a lot more volatility. You could have the stock trading at $5 a share, and then they announce that they have this new drug that's doing great in trials, and it seems to be effective for treating whatever disease it's attempting to treat. And you can see that stock go from $5 to $10 in a single day because they have some new information that justifies paying a significantly higher price. Now, information moves stock prices. As investors learn about new developments at the company or the economy in general, they adjust their perceptions about what a company is worth. Now, here's the thing. The spread of information is not fair. Some people get better information than others. So what we have is a process of information moving from the company, which we call private information, and moving outward toward the public. So the company's here in the middle, and then there's different layers of investors who get information at different times. The people closest to the company learn first. The investment community, people that maybe run large hedge funds or institutional investors with considerable resources to gather information, they learn sooner than the group of maybe people like me who are traders who are monitoring stocks very closely using some of the techniques I'll discuss later. We get information probably ahead of the general public. The people watching the financial news on TV, reading the newspaper, they're kind of the last ones to know. And that's when information has gone fully public. It's gone from the company to the people that follow the company the closest, to the investment community or really sophisticated investors, to savvy traders and investors, and then out to the general public. And that's where most people reside. Well, if you want to beat the market, you have to get better information than most people. And so that's why it's important to realize that the information that's in the public realm is really not very useful. You have to do what the people who are the most well-informed are doing. Now, how do you do that? Well, you can either be an insider in the company, and then you are one of the most well-informed, or you can do what I do, which is look at market activity to tell us when there's something going on, when there is some new information coming into the market. And I'm going to elaborate on this in a moment. What's important to realize is that there are secrets in the market. There's always someone that knows before the rest of us. And if you want to be a good investor, you either have to do what they are doing or be one of them. Now, we're almost at the point in this video where I'm going to show you one of the key things that you need to do to be successful in the market. But first, I need to explain to you what the stock market is, and then we're going to define what an exchange-traded fund is. So the stock market is a facility for the buying and selling of stocks. Now, I want to be clear, it's not a store where you buy stocks. You're not buying shares from the exchange. You're buying shares from a person that owns the shares. The exchange is just the mechanism, the facility where that transaction takes place. Now, you can have one buyer on one side of the planet selling to someone on the other side. All that's happening at the exchange is the transaction is being completed. The stock market is a sort of forum for debate on what a company is worth. You have all these investors around the world buying and selling, casting their vote on what they think the stock is worth. We should all be humbled by the fact that when we buy a stock, there's someone on the other side of that transaction who thinks that they're right and you're wrong. You buy a stock because you think the stock should go up in price. The person selling is selling because they think the stock is overpriced and wants to take their money out. And one of them is wrong. Now, the stock market adds value to a company by providing liquidity. Remember at the top of the video, I talked about how, having a private company doesn't have as much value because it's harder to sell. When you can buy and sell things so quickly, just with the click of a mouse button or a click on your phone, it adds value because that liquidity is worth something. And that's one of the big benefits of trading publicly listed companies. We can buy and sell them very quickly, very cheaply with low transaction costs, be in and out, and take advantage of the volatility that exists in stocks. We can buy a stock at 1 minute at $10 and sell it 4 minutes later for $10.30. We've made 3% in 10 minutes. And that's what day trading is all about. Of course, we can also be longer term investors and buy a stock at $10 and sell it a year later for $20, making 100% return. But without the stock exchange, we don't have that facility to make those fast, easy transactions at a low cost. Now, the major global stock markets are the New York Stock Exchange and the NASDAQ. But many countries have their own exchanges. For example, the Canadian stock market is the Toronto Stock Exchange. And of course, they're all over Europe, all over Asia. There's stock markets everywhere. Now, originally, stock markets had people on a trading floor doing the trading. So they would get orders from their clients and they would yell at each other and arrive at prices in a public outcry type market. The New York Stock Exchange is really the only exchange that still has a trading floor, but it's not what it used to be. Where it used to be a crowded, active place, I can remember going there when I was my first time in New York and watching the trading floor and the action there. It was very exciting. Nowadays it's kind of boring because most of the people on the floor are gone, and it's now a bit of a ghost town where you just have a small number of what are called specialists who are executing primarily large trades for large institutional investors. The reality now is that most stock markets in the world are electronic, and that means your order is completed through a computer. There's no human beings really touching the order. It's all done electronically, and that's kind of the way stock markets are now. Now, another popular way for investors to invest in the stock market is through something called an exchange traded fund, or ETF for short. ETFs are a basket of stocks or sometimes other assets, could be commodities or different things related to the volatility of the market. Essentially, when you're buying an ETF, you're buying a group of something. So for example, there is an ETF, an exchange traded fund for the S&P 500. Now the S&P 500 is an index of the 500 largest companies in the world. So companies like Apple and Microsoft and Google, they're all components of the S&P 500. If you wanted to own that entire index of 500 companies, you could go out and buy them all, but that would be very expensive and time consuming. Or you can just buy the ETF for the S&P 500, which is called the SPDR, and the symbol is SPY. Now the S&P 500 SPDR moves just like the collective group of those 500 stocks. And so it's a really simple, easy way to own the market. Now there's all kinds of ETFs, literally hundreds if not thousands of them. They represent everything from baskets of stocks to sectors like the real estate sector, the technology sector. You can buy ETFs based on commodities like gold and silver and uranium. So if you want to diversify your risk by buying different groups of assets, ETFs are a great way to do that. And the beauty is you trade them just like a stock. You don't have to go to the futures market to buy uranium futures. You can just go out and buy the ETF. All right, so now it's time to talk about some of the keys to making money in the stock market. Remember at the top of the video, I talked about how information is what moves stock price, but it's not public information that's valuable because that information is already priced into the stock. If everyone knows that a company has found the cure for cancer, that stock will reflect that information. So instead, you have to use information that is not widely known to predict which stocks are going to do well. Well, that's not all that easy because most of us don't have access to private information. So we need to either have better information than others about what stocks will do in the future to get an advantage, or since most of us do not have access to better information, we have to follow those that do. And so the key to beating the stock market is to use abnormal trading activity to tell us when something is going on at a company. Now think about it this way. Let's say a company has a new drug. It treats colon cancer. And in trials, in testing, it's proving to be quite effective. Who knows that? Well, there's the doctors who are involved in the trial. There's the patients who may be part of the trial. There are large institutional investors who follow the industry very closely. They kind of know what's going on. They're insiders in the industry. Now, if that drug is starting to show signs that it's effective, what do you think all of these groups that have better information are going to do? Well, if they're rational, they're going to go and start accumulating that stock in the market before the information is widely known. Now, if you trade on private information, inside information, that's illegal. And so there's a fine line that gets walked. But you could simply be a very astute investor, someone who knows a lot about an industry, someone who has good connections in industry to make an educated guess and a smart prediction of what these companies will do in the future. And it happens all of the time in the stock market. When people that have better information use that information in the market, they create abnormal trading activity. Because if the market kind of agrees that a company's worth $20 a share, and then some new information starts to come to that small group of investors that's close to the center of that little target diagram that I showed earlier, well, at that stage, those people are acting in the market, they're buying aggressively, and they're creating abnormal price gains, and the stock will start to trade more volume than normal. Now, this has been my basis for my approach in the stock market for the last 30 years. And it's proven to be very good at finding those next hot stocks. Now, that's not all, however. The other thing that we want to do is don't buy stocks that the market does not like. Now, that seems kind of simple, but there's a way to look at a stock chart and figure out what the market likes and what it doesn't like. If you can draw a straight line with a ruler, you can do this. All you have to do is look at a chart. You can go to my website, stockscores.com, pull up the chart for any North American stock, and from that, you can now start to look for what are called inflection points. Inflection points are high points on the chart or low points on the chart, little peaks and valleys. So anywhere you see a peak or a valley, you have an inflection point. All right. If the inflection points are falling from left to right, that means the sellers are in control of the market. The investors don't really like the company, and as a result, the stock's going down over time. What we want to do is focus on stocks that have rising bottoms on the chart, where the inflections are moving up from left to right, because that tells us that the buyers are stronger and they're aggressively buying the stock. You see, every time the stock has a little bit of weakness, it doesn't get as weak as it was the last time it had some weakness. And the result is that you have these rising bottoms. Here we have a little pullback. This low point is higher than the previous low point. that's a sign of optimism. So to be a good investor, a couple of things that are really simple. Number one, don't buy stocks or markets that the general market doesn't like. And to do that, look at the chart. Are there falling tops on the chart, or are there rising bottoms on the chart? You do not want to fight against the trend of the market. Think about it this way. If you had a canoe and you put it on a river, do you want to try to paddle up against the current, or do you want to travel with the current? You know, there's a very popular cliche in trading, and that is the trend is your friend. And it's kind of like this thing that I'm talking about. We want to trade with the trend of the market. Rising bottoms, good. Falling tops, bad. Now, the other thing that I said was look for situations where the stock starts to behave abnormally. So if we go back to this stock, notice right here, there's extra strong volume and there's a strong price gain. In that particular week, this is a weekly chart going back 3 years. In that particular week, the stock went from $15 to $20 in a single week, and it traded a lot of volume. And there were rising bottoms prior to that break. And the result was that the stock went from $20 to over $100. So we always want to look to see who's in control of the market. Rising bottoms, buyers are in control. Falling tops, sellers are in control. If you have an abnormal price break to the upside with strong volume from optimism, you've got the beginnings of a good trade. I built Stockscores.com to help individual investors do better in the stock market, to help you avoid bad stocks and find the good ones. You can get the stock scores for any North American stock. Simply enter the symbol here, click on Get the Stock Scores, and if you'd like my free weekly email with my trading tactics, some of my stock picks, register for my weekly email right there. And if you're not already subscribed to the Stockscores YouTube channel, just click on that subscribe button. If you enjoyed this video, give it a like.